Hello, and today I am back to share with you a very important topic, which are the reasons to choose investing in real estate versus other types of investments. What is the nature of investing in real estate? Right, you may ask. For some people, buying a property may be the single largest investment and asset in their lifetime. It is a relatively expensive investment which tends to easily price out investors lacking capital. However, real estate can be invested in by using leverage, by borrowing money from a bank to finance the purchase of your property. Real estate also offers equity ownership over time. As bank mortgage loans are paid down, you as an owner have the ability to access capital by unlocking equity in a property or refinancing it. In addition, properties also serve to produce income for its owner, which is you, when rented out. However, there are also certain drawbacks when investing in real estate. Its price does fluctuate and the asset is difficult to liquidate instantly. Moreover, there are maintenance and repair costs to the upkeep of a property. Real estate is often a practical investment by those who no longer want to pay someone else rent. Yet, there are also a lot of properties purchased strictly for investment purposes. In this video, we will weigh the pros and cons to see how investing in real estate compares with other types of investments. Let us first take a look at bank deposits. Depositing your money in a legitimate bank while earning an interest on the amount is a form of savings while growing more money. This includes putting money into either a savings account or a fixed deposit account. Savings accounts are highly liquid and can be used in an emergency, but in return have a very low interest rate. Rates are adjusted and not guaranteed. Fixed deposits offer a fixed rate of return over the course of your contract that ranges from months to years. The longer the term, the higher the rate. The amount of interest on it is higher than a typical savings account. So how do bank deposits compare to real estate investments, you may ask? Firstly, putting money in banks has high liquidity, allowing you to capitalize on opportunities when it comes about, while you cannot react as fast if your wealth is locked down in properties. Secondly, inflation on the declining value of money erodes away your gains from bank deposit interests, while properties are a good hedge against inflation. Thirdly, depositing money in banks is extremely low risk, but investing in real estate has a risk of negative returns. That said, the return on saving your money at a bank is usually 1-digit percentage per year is very minimal. In comparison, the return on investment in real estate is twofold, from asset capital value appreciation plus its rental income. While bank deposits can be a safe place to save your money and get a little interest for it, they are not a good place to grow your wealth. Anyway, investing in real estate is a better form of savings as you pay down your bank mortgage loans, principal and interest. You are actually building more equity in your asset, and this helps you to save. All the while, the income you get from renting out your property goes into paying back your bank loans. Next, we will compare with securities. Securities include stocks and bonds. These type of personal investments have varying degrees of risk. Stocks are shares of ownership in a particular company. When you purchase an individual company's stock, you become a part owner of that company. That means when the company makes money, so do you. And when the company grows in value, the value of your stock grows as well. You can then choose to sell the stock for a profit. However, when the price of a company's stock goes down, the value of your investment goes down as well. Also, stock owners can also receive rewards via dividends if the company chooses to distribute earnings to their shareholders. While some stocks are riskier than others, most stocks see the best performance when held for a longer period of time, as in many years. So they have time to recover from possible short-term market volatility. When you purchase any kind of bond, you are loaning money to the entity you purchase it from for a predetermined amount of time and interest. But unlike a company stock, purchasing a bond does not give you any ownership in that company. Bonds are generally considered safe and low risk because the only chance of not getting your money back is if the issuer of the bond runs away. Governments issue bonds to raise money for projects and operations, and the same is true for corporations who issue bonds. Corporate bonds are slightly riskier than government bonds because there is more risk of a company defaulting on the loan. Corporate bonds are more attractive compared to bank saving interests in exchange for that additional risk that you take on. So, how do stocks compare to real estate investments? Firstly, stock values can be extremely volatile with their price subject to fluctuations in the market, but the real estate tends to see fewer erratic swings than the stock market. Secondly, you pay more taxes when selling your stocks compared to selling your property. Thirdly, although dividend-paying stocks can generate yield income, it takes a considerable amount of investment to generate that significant amount of income. In turn, properties provide passive income through long-term cash flow. Fourthly, stocks can be invested in without the need for much capital and is highly liquid, while real estate is not as liquid and is expensive to buy, although you can always use leverage. Under the right circumstances, real estate can be a very good alternative to stocks, offering lower risk, having more leverage over your money, generating you regular income, and having better tax benefits. More importantly, the price values of physical assets are less likely to become worthless compared to stocks. Now, let us move on and compare to Forex trading. Trading in foreign exchange, which is Forex, is similar to the currency exchange you make while traveling abroad to other countries. You as a trader buy one currency and sells another currency, and the exchange rate constantly fluctuates based on the supply and demand for currencies. Forex trading is also the most liquid form of investment. This is so because buyers and sellers are constantly trading, making it easier to make trades and turn assets into cash with typically low transaction costs. But the fluctuating market conditions can result in losses far more than your original investment. For example, since Forex trading involves the currencies of other countries, you will face the risk of changing interest and exchange rates, as well as economic and political issues in the other country. You could wake up one morning to find a foreign currency has experienced a significant drop in value overnight because of an unforeseen political problem. So, how does Forex trading compare to real estate investments? Firstly, to make money from Forex, you require vast knowledge and understanding of economic and financial indicators of different countries in order to make intelligent guesses on which currency to invest in. Conversely, factors related to real estate investing are comparatively much simpler to grasp. Secondly, the risk of capital loss from Forex can be huge, while properties are a more stable alternative to protect your capital. Thirdly, you can make quick and large speculative profits from trading in Forex, but real estate requires a longer-term investment horizon. Trading in the Forex market takes time and skill, and the understanding that it involves significant risk of loss and might not be suitable for just anyone. On the other hand, real estate is much more accessible for just about anyone to learn how to invest in it. Now let us compare commodities. Commodities include the likes of precious metals such as gold and silver, or even crude oil. The practice of investing in gold is one of the traditional types of investment that goes way back. Commodities are typically considered low-risk types of investments. Keep in mind that low-risk investments also tend to have low returns, and that doesn't necessarily mean it's a great investment. Since gold is a commodity, its price is based on scarcity and fear, which can be impacted by political actions, economic uncertainty, or even environmental changes. If you are investing in gold, be aware that your protection against a price drop is based on external factors that is beyond your control. Therefore, its price can fluctuate a lot and very quickly. The price tends to go up when scarcity and fear are widespread in the world and down when gold is widely available. So, how do gold compare to real estate investments? Firstly, the price of gold can be extremely volatile with daily fluctuations, but real estate price tends to be comparably inelastic. Secondly, you will not be able to increase the price of gold, but it is possible to increase the value of your properties. Thirdly, you can only buy the same amount of gold as the money you have to invest, while from properties you can leverage on bank financing to purchase at a higher value asset. Fourthly, gold is highly liquid, easy to buy and sell, but selling your property could take months to complete. Gold is worth investing in if you know that scarcity is going to create a demand for gold and drive up the price. If not, you will likely be making significant losses. This is where real estate investing is much more stable and advantageous compared to the investing in gold. Now, finally, we are going to compare to a more modern and interesting form of investment, which are cryptocurrencies. Cryptocurrencies are one of the newer types of investments, and they have gained a lot of interest in recent years as an investment vehicle due to their dramatic growth. However, they remain an incredibly risky investment because of their speculative nature and the many unknown factors related to them. The risks of trading in cryptocurrencies are related to it being, number one, volatile. Unexpected changes in market sentiment can lead to sharp and sudden moves in its price. It is not uncommon for the value of cryptocurrencies to quickly drop by hundreds, if not thousands of dollars. Number two, unregulated. As a decentralized currency, cryptocurrencies are currently unregulated by governments and central banks. They were developed to be free from government oversight or influence and are instead monitored by peer-to-peer internet protocol. Number three, susceptible to error and hacking. As a digital currency sold on cryptocurrency websites, they are susceptible to technical glitches, human error, or even hacking. Number four, affected by forks or discontinuation. A fork happens when a cryptocurrency community makes a change to the blockchain set of rules. When a hard fork occurs, there may be substantial price volatility around that event, and trading may be suspended throughout. In addition, there is the possibility of government action and the possibility that the cryptocurrency will never see widespread acceptance as a form of payment. Having no intrinsic value, cryptocurrencies could disappear as quickly as it came into existence. At this point, no one knows for sure what the future holds for cryptocurrencies. So investing in cryptocurrencies is little more than speculation, if you ask me. Do not invest in things we do not understand, because that is simply just gambling. Finally, to conclude, so how do cryptocurrencies compare to real estate investments? Purchasing cryptocurrencies do not require huge capital. It's low maintenance and high risk, yet with the potential for high reward. Contrarily, real estate is a long-term investment that could end in a big payout down the road while providing regular income in the meantime. Therefore, it ultimately depends on how much you can afford to invest and what you can afford to lose. What I have just covered are 4 alternatives to real estate investments which people tend to adopt in comparison to buying properties. So what I would just like to share with you is to weigh your risks and gains from alternative investments to real estate and make your decision whether real estate investing is for you. Do remember to like, share and subscribe to our channel and to this video. Your support means a lot to us, and I will see you soon.